Okay, so we've spoken about inflation quite a bit on this channel, and we know that it jumped 5.4% in July versus July 2020, which is the biggest jump since 2008. Now, there's a lot of debate of whether this is transitory or not, and we've discussed that at length on this channel. But one thing I did want to do was to start thinking of a plan of what type of stocks would you want to be in, what types of investments and asset classes would you want to be in if inflation is high, so in a high inflation environment. And what I found was in 2015, Warren Buffett, the sage of Omaha himself, who's one of the best investors of the last few generations now, gave some advice around his thoughts when it comes to which types of companies to invest in during a high inflation environment. And his quote is as following: "The best businesses during inflation are the businesses that you buy once and then you don't have to keep making capital investments subsequently." Okay, so what he's saying here is any business with heavy capital investment tends to be a poor business to be in and is often a poor business in general. So what he's saying is the following: if a company is making high capex purchases, so they're having to spend a lot each year in capex to generate their returns, each subsequent year as inflation rises, the cost to them of that capex is growing. Yeah, whereas their profit will not necessarily carry on in turn unless they're able to force that prices onto end consumers. Okay, which is cost push inflation. So what he is saying, and I did a bit of research to find out what are these high capex businesses. There's various such as utilities and railroads, but in the modern day, even some of these tech companies, you have to be careful to look at which of these have high capex. For example, Google, Alphabet have very high capex. AT&T, Amazon, Verizon, Microsoft also have high capex. So these are the kind of companies we'd want to kind of look at and just reevaluate in our portfolio. I'm not saying just remove them. I'm saying this is just based on this specific point of if inflation is high, you'd want to stay away from companies with high capex. Maybe we need to take a look at these companies if they're in our portfolio. And then it got me thinking then, hang on a second, if they're paying more for capex, these companies, these utilities companies and railroad companies and all the other construction companies out there, who's going to benefit from that? Well, naturally, there's going to be a bunch of companies who benefit from this increase. And that is the likes of Caterpillar, who's building heavy machinery, Deere and Company, Honeywell. You can look into these companies because they're building machinery, materials, heavy machinery, diggers. These are the kind of companies that will probably benefit as the cost of high capex goes up, which is interesting. Now, what solution did Warren Buffett give? Well, he said he prefers to own brands, and we know that from Warren Buffett. We know he's heavily invested in Coca-Cola from very early on. We know he owns See's Candy from 1972. He feels, and I quote, "A brand is a wonderful thing to own during inflation." And it's a clever concept because if you think about it, brands are the least price elastic, right? So they're the least likely. So if people want a brand, they're less influenced by the change in price, right? Versus a non-branded item. That's just the fact of the matter. That by definition, why these companies with heavy, strong brands are really valuable. So it got me thinking. I've just brainstormed a few, and there will be tons more. Drop them in the comments if there are any other strong brands which you believe in. But companies such as Coca-Cola, like we said, Under Armour, Nike, Apple, these are the kind of companies that have built strong brands and perhaps are less price elastic in an inflationary environment. If people want that type of top, they're going to go to Under Armour or Nike. If they want a Coca-Cola, are they going to really stop buying Coca-Cola if it inflated by 5%? So if a bottle of Coke goes up by a couple of pence, would that be a concern? And then Warren Buffett says owning part of a wonderful business is useful because no matter what happens with the value of the dollar, the business's product will still be in demand. And that's the case here. That's exactly what I just said there. Regardless of the environment, these types of brands are still going to be desired. And that's why it's an interesting investment to be in. And I highly recommend we all have some of these companies, some of this exposure, because just a company with great fundamentals without a brand may not fare as well in an inflationary environment. So the next point that comes out is it'll be a good opportunity to also be in real estate. And the reason for being in real estate is it's a one-time outlay and you can benefit from the appreciation. So you can resell it afterwards. And the important thing here is if you have something which is useful to somebody else, that tends to be priced in the replacement value. They tend to price in the replacement value. So in essence, you will get that inflationary kick. So if you're buying a house and you bought it for, let's keep it really round numbers, you bought it for £500,000 and it's a 2-bedroom house, and inflation starts to go up, then people will price that house based on what a 2-bedroom house costs. So naturally, your value of your house will go up in line with that. So the key here is owning what people want, owning what's desirable, whether it's in stocks, whether it's in real estate. Go back to what is truly desirable, not just speculative investments which you own because you think it's going to go up. And I think that's the important here. Let's just, in an inflationary environment, the tactic is to draw back and to consolidate in products, brands, companies which people will desire long after inflation has come and gone. And that's the key here. And the Sage of Omaha kind of wraps up by saying the best investment strategy of all, and we know what he promotes here, is consistently buy the S&P, dollar cost average into the S&P, and he says keep buying it through thick and thin, and especially through thin. Now, whilst I agree with that as a broad set of advice, there's, you can't go wrong really dollar cost averaging into a low cost index fund, mutual fund. I would say that if you're on the start of your wealth journey, this probably isn't going to get you wealthy. I mean, if you're starting off with £10,000 or $10,000 and you're growing at 6% per annum, it's going to take you a lot of time to get to 20 grand and 30 grand and 40 grand. So you're not going to be building the wealth at the rate you want to really push through. And that's where you're going to have to take a few more risks in high growth companies. But yes, if you're ready, have a solid cost basis, you've already built your wealth or you've inherited some wealth and you've got a large amount, then it's a safer thing to do to invest in the S&P, dollar cost average, and just let it appreciate over time. Okay, so there you have it, guys. I thought that would be a little snippet of advice for us all. If we are indeed heading into a long-term inflationary environment, which is going to carry through 2022 and maybe 2023, it's important that we understand as investors, what should we be flocking to? How should we be thinking about this environment, and what types of companies can navigate that environment well? So there you have it, guys. We'll see you in the next one.